Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. You see, the world of trading is so full of hype and clickbaity content that it becomes quite hard to sift through the noise and find stuff that matters. Through this show, The Long and the Short, we will take the long road to the world of trading because, as in life, in trading too, shortcuts don't get us anywhere. So here's the format. Each week, part 1 dives into trading concepts, insights, questions, and part 2 recaps the market moves for that week. With that, let's get started with episode 1, part 1. Today we'll cover some basics and some big questions. I'll start with the term that's often heard, frequently used, but perhaps not always fully understood, and that's trading. And while we are at it, I'll address an uncomfortable question I am often asked. Is trading some sort of legalized gambling? And then I'll build a case to help you answer the third question of the day. Why should you even trade? So what exactly is trading? At its core, trading refers to the act of buying and selling financial instruments such as stocks, commodities or derivatives like futures and options, and holding them for no more than a year. The key difference between trading and investing lies in the holding period. For instance, if you buy shares of Reliance today and sell them after 11 months, that counts as trading. However, if you sell them after 12 months or more, that's technically considered investing. This distinction is important, especially when it comes to how your gains are taxed. But what about strategies that involve frequent rebalancing? Imagine a scenario where you buy 20 stocks and rebalance them at the end of each month. For instance, you might sell 5 underperforming stocks and replace them with 5 better performing ones, maintaining a total of 20 stocks consistently. With such a strategy, you likely won't hold many stocks for more than a year. Would you classify this as trading or investing? Even active mutual funds use such rebalancing strategies. However, as an investor, you don't directly see this activity or bear the immediate tax burden. So there's no single clear-cut answer as to what you would call this. You could perhaps call this long-term trading. I actually don't know. In short, technically speaking, holding an instrument for more than a year is investing, and holding it for less than a year is trading. Derivatives, that is futures and options, are products designed with a shelf life of under 1 year. So dealing in them by default becomes trading, with a minor exception of what we call as leaps, which we'll get to at some point later. With the question of what constitutes trading sorted, let's move to a bigger and more controversial question. Why is investing often celebrated while trading is perceived as gambling? Before we answer that, I'll have to first define what makes something gambling. The litmus test is quite straightforward. The idea is to determine if you can use your skills and strategies to tilt the odds of winning in your favor. If you can, it's not gambling. I repeat, if you can use your skills and strategies to increase the odds of winning, it's not gambling. Now, you may be wondering, what exactly do we mean by odds of winning in the context of trading? Bear with me, it's a bit technical, but I'll explain with a simple example. There are 2 key ways to think about this. The first is win rate. Let's say you play a game 100 times. Each time you either win 10 or lose 10. Suppose you win 50 times and lose 50 times, which means your win rate is 50%. With a 50% win rate and a 1:1 risk-reward ratio, would you make money? No. You might break even in theory. In reality, there are transaction costs, so you will more or less be at a loss. So win rate tells you how often you win, but not how much you win when you do. That's where the second concept comes in: average win size versus average loss size. Let's go back to the example. But this time, suppose your win rate still stays at 50%, but the difference is when you win 11, when you lose 10. Now what happens? Now, even though you're winning half the time, you're coming out ahead positive because your average win is larger than your average loss. And that's a key insight. In trading, you have 2 primary levers to improve your outcomes: increase your win rate above 50%, or ensure that your average win is larger than your average loss. Now, when I talk about using skills to improve your odds, I'm referring to working on either of these two levers. Increase the frequency of your wins or increase how much you win when you do. If you are able to do this through deliberate strategy and consistent execution, you are not gambling, you're trading with an edge. On the other hand, if you are placing trades based on gut feel, random tips from some social media handle, hunches, that's not really strategy, that's just coin toss. And when you gamble like this in the markets, your failed trades often magically turn into your long-term investments. Now let's be honest, if you ever held on to a loss-making position hoping it'll bounce back, you know exactly what I mean. I don't know about you, but I would be lying if I say I've not done that. Anyways, speaking of gambling reminds me of this fascinating story of this guy called Ed Thorpe. He was a math professor who cracked a card game called blackjack by figuring out how to beat the casino's odds. He used probability and a method called card counting to create a strategy that worked so well for him that he eventually got banned from multiple casinos. He then tried to disguise himself and sneak into different casinos. I'm not kidding, this is a real story. He even wrote a book about it called Beat the Dealer. I'll link it in the show notes in case you want to check it out. But here's the key takeaway. Ed Thorpe didn't gamble even though he was playing a game that was popular in the world of gambling. He used math, discipline, and a strategy to beat a system designed to make people lose. And that's the difference. Even in a gambling environment, skill and strategy matters. In fact, Thorpe later applied the same principles to the stock markets and became one of the early pioneers of quantitative trading. So remember, if you can define your strategy and execute it consistently, you're trading. If not, you're just gambling. To make it easy, I will share with you a checklist of 5 questions to help you assess whether you're trading with skill and strategy or you're just gambling your way to glory. 1. Do you have a defined method or a rule set for entering trades? 2. Do you have a clear plan for exiting trades both when you are profitable and when you are at a loss? 3. Before placing a trade, do you know how much you're willing to lose on that trade? 4. Do your skills and strategies help you increase the odds of winning in your favor? And lastly, number 5. Do you log all your trades? If your answer is yes to all these questions, irrespective of whether you're profitable or not, you're doing it right. As they say, the only traders who are always profitable are the ones who don't trade. That applies to any business actually. So it's fine to have measured losses so long as you have your trading processes in place and you know there is an edge in your trading strategy, be it in terms of win rate or average win size. That's the first step. With that, I'll come to the third question I would like to deal with today, and that's why should you trade? You've probably heard conflicting advice out there. On one hand, veteran investors and money managers, especially in India, warn against trading, calling it risky, speculative, and even reckless. On the other hand, social media is full of influencers who promise you the riches through trading. The truth, as usual, lies somewhere in the middle, and that's exactly the perspective we are taking today as we explore a fundamental question. Why would anyone even consider trading? We'll break this down into 2 key parts. The first is a fundamental reason, and that is what should drive you to trade, if at all that is. Before we dive in, let's take a quick detour into a powerful concept called deliberate practice. I came across this idea in a book titled Peak: Secrets from the New Science of Expertise by psychologists Anders Ericsson and Robert Poole. In the book, Ericsson breaks down what it truly takes to become an expert in any field. If you want to go down that rabbit hole, I'll link the book in the show notes. It's a great read and Ericsson is a big name in the field. So what exactly is deliberate practice and why am I talking about it here? Think about any skill you want to master, be it chess, playing an instrument, swimming, photography, could be anything. Science says simply practicing a lot isn't enough. You need to practice with a purpose. That means constantly reflecting on what worked and what didn't and making adjustments. It's also about seeking feedback from experts and incorporating that to improve your skill. This is how true expertise is built, and that's what is deliberate practice. Now let's apply this to trading. When you actively trade or invest, Whether it is in stocks, derivatives, commodities, or even mutual funds, you're actually learning firsthand how these complex financial products work. Each has its own rules, behaviors, and quirks. And unlike long-term investing, trading gives you immediate tangible feedback. You know fairly quickly in a day, a week, or a month if your decisions are working. Now that feedback loop is pure gold for accelerating your learning curve. But it's not just about understanding the products either. Trading also exposes you to a wide universe of strategies like trend following, mean reversion, option spreads, factor investing, long-short portfolios, and even designing your own structured products. The truth is, it's incredibly difficult to grasp how any of this works unless you try it for yourself. So the first and the fundamental reason to trade, if at all, is this. It's the ultimate form of hands-on, real-world learning of financial products. You can read everything that's out there, but if you don't place that buy or sell order all by yourself, all that theoretical learning means nothing. Now, if you're still with me so far, you're probably thinking, what's the use of learning about financial products in the first place? Well, that's a great follow-up question, and I'll answer that next week. So far in this episode, I have addressed 3 fundamental questions. What is trading? Is trading same as gambling? And a bit about why should you trade. In short, trading refers to holding an instrument for less than a year. 2, if you can use your skills and strategies to tilt the odds of winning in your favor, you're not gambling. And 3, trading is a great way to learn about all the financial products that exist. With that, let's move to part 2 of this episode, something more practical, and that's a weekly market metrics. Since this is the first episode, here is what you can expect in market metrics. Every week, we'll analyze the markets through a set of metrics. When I say metrics, I mean things like rate of change, current trend of different indexes, the top performing sectors, all of that. Now there's a detailed video of what these metrics are and why we chose them. The link is in the show notes. Do watch it to make better sense of this section. Here's the market metrics this week. Let's take a look at how the market shaped up. I will start with ROC, that is rate of change. After 6 consecutive weeks in the red and a brief uptrend last week, Nifty has finally managed to close higher than the previous week's close. That said, the close wasn't particularly strong. Markets appear to have largely digested the tariff story, and the last weekend's buzz around GST reforms gave the much-needed boost. Still, there's an undertone of uncertainty that traders and investors are trying to make sense of. At least that's what I see at the moment. But here's the thing. If you zoom in a bit, you will see that while Nifty 50 kept moving up, Bank Nifty didn't really follow up through at the same pace. And that matters. Nifty 50 is heavily tilted towards the banks and financials. Banks alone have around 30% weight, and if you include other financials, it comes close to 37%. So if banks don't catch up in the coming week, they could actually drag the index down. Talking about sector-wise markets, if you look at the table, autos once again led the pack, followed by realty, consumption, and FMCG. Autos have been strong for a few weeks now. Consumption is holding up well for a second week, and reality plus metals are the new entrants to the top 5 list. It almost feels like autos and consumption stocks knew something positive was brewing on the GST front. Moving to the overnight versus intraday structure, specifically in Nifty, Monday opened with a massive gap up of 326 points, that's about 1.3%, but that momentum didn't carry through for the rest of the week. We got positive gaps only for 3 days out of 5. Intraday was net negative. That means in totality, this week markets went up in gaps, but intraday basis markets went down. This is in sync with the classic overnight drift pattern. And if you are an options trader, this could be of interest to you. Let's look at the straddle prices and the ranges. Index options expiry for Nifty and Sensex was fairly calm this week. IVs were low and expiry day price action was muted, pretty much what option sellers and short wall traders would always want. If you zoom into intraday moves a little bit, the 10-day average daily range for Nifty sits at around 170, but this week the average range was just around 150, which is quite muted. And since volatility is mean reverting by nature, we should expect intraday ranges to expand a bit more in the coming weeks. Something to keep in mind if you're selling options. And speaking of the coming week, it's a monthly expiry week, and if you run anything specifically for monthly 0DTs or last week strategies, this is going to be your week. On the directional bias so far and the possibilities for the coming week, if I look at the technicals, the picture looks just about okay. All the major indexes except for Bank Nifty are trading above their 21 and 50-day moving averages. That's some sign of strength, but looking at today's price action and close, it doesn't give me much confidence. I would keep an eye on Bank Nifty for it to show some strength. On the news front last week, two things stood out. The Trump-Zelensky meet turned out to be a complete non-event for us, while the GST reform chatter definitely gave a boost. Looking ahead, there aren't major announcements lined up for the coming week, but the short-term trend following systems that I track both on Nifty and Bank Nifty are short at the moment, so maybe the market could continue to have a flat to mildly negative bias for the next few trading days. So yeah, that's pretty much for this week's market metrics. Let's see how the coming week pans out. I hope we don't breach the 24,300 levels again on Nifty. Fingers crossed, and trade safe and see you again next week.